It's the only profitable new business company to go public so far. It's created a new market in India, and guess what? It's a woman-led enterprise. So that's three rare things coming together.
In a few years, it became one of the most profitable startups in the country. In 2020, Nykaa became a unicorn, and in 2021, it went public.
The most sought after, the most chased, and the most infamous listings of its times. The stock, by the way, is now struggling at its 52-week low.
From its post-listing high, the stock has actually corrected over 60% and it's fallen below the IPO price of 1125.
और एक खबर भी है, इंटरेस्टिंग खबर है, नायका बोनस शेयर पर विचार करने वाली है सर.
Hi everybody! On 20th of October 2021, Nykaa launched its IPO and became a star in the Indian stock market. This was because it was the only e-commerce company to be profitable during that time. And as soon as it got listed, its shares peaked to touch 2,574 rupees. But in the next few quarters, something crazy happened. Nykaa's profits fell by 96% and the stock price started falling. From its issue price of 1,125 rupees, Nykaa shares reached a peak of 2,574 last year before falling back to 1,134 rupees. And it's not just Nykaa, but even PAYTM and Zomato have seen a steep decline in their stock price, whereby their stocks fell by 77.5% and 46% while making this episode. But this is where Nykaa came up with a genius strategy, whereby they gave out bonus shares of 5:1 to all of its investors. And this resulted into such a chaos in the market that while on one side they called it a masterstroke and called Falguni maam a genius, on the other side they called this a corporate governance nightmare. And regardless of what this is, this case study has got some very valuable lessons to us as students of business and retail investors. So in this episode today, let's do a deep dive and try to understand what is the deal with Nykaa's bonus share strategy, why did it cause such a heated debate amongst its investors, what is the secret strategy behind this bonus share issue, and as students of business, what are the study materials to help you understand this financial strategy better. This video is brought to you by Small Case, but more on this at the end of the video. The first thing you need to understand is how do startup fundings work and how do institutional investors make a ton of money with IPO. So as usual, let's try to understand this using an oversimplified story. Let's say thinkschool today goes from being a bootstrap startup to becoming a VC funded startup. This is when we'll raise our Series A in funding. So I and Parsh both own 50% stake in the company. But in Series A, we would dilute 5% of our stake and raise 10 crores in funding from Stark Holding. So the valuation of our company is 200 crores right now. Why? Because if 5% is equal to 10 crores, then 100% of the company will be valued at 200 crores. Then after some time when our profits go from 3 to 4 crores, we would again raise a round of funding for expansion. But this time, we would raise 20 crores for another 5% stake in the company. So let's say this funding is coming from Baratheon Holding. So now, the company will be valued at 400 crores. Why? Because if 5% is worth 20 crores, then 100% will be worth 400 crores. So Series B funding is done. Now the catch over here is that when Stark Holding funded us, they bought 5% at 10 crores, which means they bought 1% stake in our company for 2 crore rupees. But the next investor bought the same 1% at 4 crore rupees and valued the company at 400 crores. This means now the value of Stark Holdings investment has doubled to 20 crore rupees. Similarly, when we raise Series C to give out another 3% for 30 crores, the company will be valued at 1000 crores. So if 100% of thinkschool is worth 1000 crores, what is the value of the 5% stake of Series A and Series B investors? It will be worth 50 crore rupees. But you see, all this value that we're talking about, all of this is just paper wealth. Stark Investment just cannot impulsively sell their 5% and make 10x profits, right? And same is the case with Series B and Series C investors. Now, although technically they can sell their stake to other investors, usually these investment companies wait for a grand exit. So the question is, how and when will they get this grand exit? And the answer to this is nothing but IPO or Initial Public Offering.
देश का सबसे बड़ा IPO।
India is in a very nascent stage for technology IPOs.
KFin Technologies IPO has opened up for subscription.
बैक टू बैक हेल्थकेयर से जुड़ी बड़ी कंपनियों के बड़े IPO की तैयारी हो रही है।
Navi Technologies, a financial services company, is likely to file its DRHP for its IPO this week.
लंबे समय बाद एक IPO आया है बाजार में।
And this is when the investors sell their stake to the public and exit with their return on investment. So now what will happen is that since thinkschool is valued at 1000 crores, we will first of all split the company's stake in the form of shares. So let's say we decide to break the stakes into 1 crore shares, which means one share will be worth 1000 rupees and 1 crore shares will be worth 1000 crores. This is when the board will decide on the listing price. Now obviously these series A, B and C investors would want to make money, right? So we would list thinkschool at the Bombay Stock Exchange at 2000 rupees per share, which means we are valuing the company at 2000 crores. So now, before going IPO, let's quickly have a look at the value of the investment of all of our investors. For Series A, Stark Holding bought 5% at 10 crores and now at 2000 crore valuation, this investment is worth 100 crores. Similarly, for Series B, Barathir Investment bought 5% at 20 crores, which is again worth 100 crores. Then in Series C, Lannister Holdings bought 3% at 30 crores, which is again now worth 60 crore rupees. So now, while going IPO, let's say all these investors, including me and Pash, decide to sell 2% stake each to the public. So in total, we have 10% of thinkschool going IPO, which means we would be raising 200 crores from the public and float out 10 lakh shares. And just before going IPO, there is one little catch. Now you see, we all saw how PAYTM and Zomato's IPO crashed, right? So we at thinkschool would want to secure our IPO such that the share prices do not crash after IPO. This is where just before going IPO, we would approach our billionaire friends Digvijay and Ayush and ask them to buy some shares in bulk before going IPO. And since they're taking a risk, we would sell them these shares at a discount. So if the listing price is 2000 rupees, we would sell to Ayush and Digvijay at just 1500 rupees and then we would go IPO. So when we go public, all the thinkschool subscribers would rush to buy thinkschool shares. Thinkschool will successfully raise capital and all the investors will have made almost 40 crore rupees each, with the rest of their investments still with thinkschool. Now this amount will be less than 40 crores because we sold some shares at a discount at 1500 rupees to Ayush and Digvijay. So this is how Series A, B and C investors, in spite of investing only 10, 20 and 30 crores, in spite of selling just 2% stake, they would have already made almost 40 crore rupees each. And even after profits, they would still have 3%, 3% and 1% stake left in the company respectively. So Parsh and I will also get almost 40 crores with the majority stake still in the company. On top of that, if the share price shoots up to 2,500 rupees, our pre-IPO investors like Digvijay and Ayush, their investment value will appreciate by 66%. This is how the initial exit of the investors happens. And the catch over here is that these investors cannot sell the rest of their stake immediately after IPO. And this applies both for angel and pre-IPO investors. Why? Because if investors sell large amounts of their stock, the stock value would plummet immediately. And the new SEBI rules say that this period is 18 months for controlling shareholders, 6 months for venture capitalists, and for pre-IPO investors back then it was 1 year, but now this lock-in period is 6 months. And this is where the season 2 of the exit starts. So let's say thinkschool ended up overvaluing the company and now the shares are trading at just 1600 rupees, which is 20% lesser than the IPO price. This is when the Series A investor who's Stark Holding, they would get anxious. So immediately after the lock-in period is over, they would want to sell their remaining 3% before the valuation drops further, right? Because right now, their investment is still in profit even after a 20% slide in share value. So this is when, after the lock-in period, Stark Holding would start selling its shares at 1600 rupees. So if they sell 3% of their stake, which is 3 lakh shares at 1600 rupees, they would still make 40 crore rupees in spite of investing just 10 crores into thinkschool on top of the IPO profits. This is when even Digvijay and Ayush will panic at 1600 rupees because they had bought the share at 1500 rupees. So as soon as the lock-in period ends, they would quickly want to exit and book at least 100 rupees profit per share. And because of this, there'll be more negative sentiment in the market, and again, the share price might drop further to 1500 rupees. This is how the mass selling of the institutional and pre-IPO investors affects the share price of the company after the lock-in period ends. And this is what happened to PAYTM and Zomato, whereby after the lock-in period ended, the stock price started falling very, very drastically.
और फोकस करते हैं एक स्टॉक पर और वो है पेटीएम.
Shares of PAYTM now valued at less than 1/3 of its initial offer price.
The PAYTM stock has opened over 9% down.
जिन लोगों ने 2150 रुपए में शेयर खरीदा, उन्हें पहले ही दिन कम से कम 9% और ज्यादा से ज्यादा 27.5% का घाटा हो चुका था.
Zomato launched its initial public offering today. The IPO, considered one of India's biggest this year.
Zomato announced its April to June quarter results for the financial year 2021-22. Reporting a net loss of 356 crores.
One stock which is not doing too well and hasn't done well has been Zomato, down 12% today, and the volumes are piling up.
If this is very, very clear to you, let's try to understand the story of Nykaa. Now, Nykaa's story is very, very similar to the made-up thinkschool story that I told you, whereby they raised 20, 60 and 100 crores in Series A, B and C, and hundreds of crores in multiple other rounds thereafter. And as the company grew, their valuation grew from 120 crores after Series A to 500.7 crores in Series B, 5,713 crores after Series C, and 10,140 crores after Series E. And that is how Nykaa became a unicorn. And because of the extraordinary strategies of Nykaa, they did not just become a billion-dollar company, but also became the only profitable unicorn in the Indian market. And this is when they went IPO.
Our focus is on Nykaa.
थोड़े ब्रेक के बाद फिर से IPO एक्शन गर्म हो रहा है, Nykaa के IPO.
And Nykaa IPO kicks off tomorrow.
FSM ecommerce ventures limited यानी कि Nykaa को अपना IPO लेके आने वाली है.
And just like I got Digvijay, Ayush as my pre-IPO investors, even Nykaa got members like Narottam, Mala Gopal and Lighthouse India Fund as their pre-IPO investors. But after they went IPO, their profits went down by 96%, and because of the negative market sentiment around startup and the fear of recession, the share price of Nykaa dropped by more than 40% from its peak. And now, just like Ayush and Digvijay wanted to sell their stake at thinkschool and exit thinkschool with their profits, the pre-IPO investors like Narottam, Mala Gopal and Lighthouse India Fund wanted to exit Nykaa. And since they had a 1-year lock-in period to be followed, they were waiting for 10th of November 2022 to sell their shares and book their profits. So obviously, in spite of such low prices, if another huge number of shares flood into the market, the share price of Nykaa would fall even further, isn't it? This is what is being stated as the reason why Nykaa's team came up with a genius strategy to prevent their stock prices from falling. The question is, what did they do? Well, this is when they came up with a bonus of 5:1, which means the investors will get 5 bonus shares of Nykaa for every share held. So if you owned 1 share of Nykaa worth 1,200 rupees, it will be split in 6 parts. And after split, you will have 6 Nykaa shares worth 200 rupees each and 1,200 rupees in total. So in reality, if you see, the value of the investment doesn't change, but only the quantity of your shares increases by 6 times. Now the question over here is, how was this issuing of bonus share expected to prevent Nykaa's share price from falling and the institutional investors from selling their shares? Very simple. It is because of something called capital gains tax. This is nothing but the tax that you have to pay on the profits that you've made by selling your shares. So if you buy and sell your shares within 1 year, you will incur short-term capital gains of 15%. And if you sell it after 1 year, you will incur a long-term capital gains tax of 10%. So if you say make 1,000 rupees profit within 1 year and you sell it, you will incur a 150 rupees tax. And the same thing applies for long term also, whereby if you sell it after 1 year at 1,000 rupees profit, you will have to pay 100 rupees in tax. If this is very, very clear to you, let's come to Nykaa again. You see, when Nykaa gave you 5 bonus shares, the cost of these bonus shares is considered to be free, and the value of that 1 share can be considered to be dropped. Which means, if you owned 1,200 rupees worth of Nykaa shares and you get a bonus, now you have 6 shares worth 200 rupees each. So according to India's taxman, this 1 share's value has dropped from 1,200 rupees to 200 rupees. So you have incurred a loss of 1,000 rupees. Whereas these other 5 bonus shares were bought at 0 cost because they are bonus shares. And now their value is 200 rupees. So according to the taxman, you have made a profit of 200 rupees on these bonus shares. Therefore, you will have to pay a 15% short-term capital gains tax on this 200 rupees if you sell it immediately after bonus. So just to make it more accurate, in case of Nykaa, let's assume you bought one share of Nykaa during the IPO at 1,125 rupees. So after the bonus issue, you were issued 5 additional shares for which the cost of acquisition is 0 for tax purposes. Now, if you sold all 6 shares on 14th of November at 210 rupees per share, you would book a loss which would be classified as long-term capital loss of 915 rupees on that one share that you bought during IPO. So you don't have to pay tax on that. Why? Because you bought that share at 1,125 rupees during IPO. But for the other 5 bonus shares, your total profit would be 210 rupees into 5, which is 1,050 rupees. Why? Because you effectively bought them for free and now they are worth 210 rupees each. So these 5 shares are giving you a profit of 1,050 rupees. So this 1,050 rupees would be classified as short-term capital gains, for which you will have to pay 15% tax, which is equal to 157.5 rupees. Therefore, your net short-term profit will be 892.5 rupees. So you have 892 rupees left from your bonus shares post-tax and 210 rupees left from your original share. And this makes it a total of 1,102.5 rupees. Which means in this entire transaction, your net loss is 1,125 rupees minus 1,102.5 rupees, which is equal to 22.5 rupees. And for those who think you can apply tax loss harvesting, this is not possible because long-term capital losses cannot be set off against short-term capital gains. But if this bonus was not issued and you sold one share on November 14th, the share price would have been 1,260 rupees, not adjusted for bonus. So you would have made a profit of 135 rupees. So you see, this is how Nykaa's finance team has effectively put a very big blockade for their pre-IPO investors and the retail investors, because of which we will have trouble selling those shares. But as it turns out, even then, the pre-IPO investors sold those shares. But now, along with the share price going down, the reputation of Nykaa's founders has taken a hit. Which is why you will see a lot of articles bashing or questioning the ethics of the Nykaa team. Now, I don't know if this is right or wrong, but there are 2 ways to look at it. Number 1, Nykaa did not do the right thing because these investors were the reason why they could actually run the company, expand rapidly, challenge Amazon, go IPO and become a $1 billion company. The second way to look at it is that Nykaa did not do anything illegal, isn't it? And as a company, all they did was protect their share price from falling, which would affect retail investors like you and me. And considering the upcoming recession, every company's primary objective is to survive by hook or crook. And for a company like Nykaa that has already given out extraordinary returns to its pre-IPO investors, until they operate within this legal binding, everything is fair, isn't it? But like I said, regardless of whether this is right or wrong, for us as students of business, it's very, very important to know about these basic frameworks of startups, funding, IPO and capital gains. And that's why we decided to cover this case study. And this brings me to the last part of the episode, and that are the study materials to help you understand startups, funding and taxes better. But before we move on, I want to thank our partners of this episode, and that is Smallcase. People, you might have seen a lot of Smallcase ads while watching Shark Tank, but do you know how you can actually use it to your advantage? Smallcase is this wonderful company which creates a basket of stocks based on a theme. Say for example, in today's market, internet companies are bound to do well. But how many internet companies do you actually know about? We all know about the Nykaas and Amazons. But we'll have to do a lot of research to know which other companies are these underrated stocks that are actually benefiting from this existing digital wave that's going on. And even if you find them, you won't be able to keep a track of which companies will do well and which companies will not. So here's where the digital inclusion Smallcase comes in, which consists of a basket of high quality stocks that are expected to perform well in the next 3 to 5 years. And the best part about Smallcase is that the Smallcase managers themselves do the research and periodically rebalance the Smallcase based on the market movements, such that you get the best returns in any market conditions. All you have to do is invest in the Smallcase using a preferred method. It can be both SIP or lump sum. And that's it. From there onwards, the brilliant Smallcase managers will take care of your investments. So if this sounds useful to you, check out the digital inclusion Smallcase from the special link below, and don't forget to sign up to explore other Smallcases in the app. Moving on to the study materials, the first thing I'm attaching is the Economic Times article on Nykaa and their financial strategy. Secondly, I'm attaching a Money Control Pro article to help you understand short-term and long-term capital gains in case of Nykaa better. And lastly, I'm attaching a document on IPO exit to help you understand startups and investments better. So do have a look at them and let me know what you think. That's all from my side for today, guys. If you learned something valuable, channel, please make sure to hit the like button in order to make YouTube ever happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye bye.